All right, thank you all for joining me today for the Loan Repayment Strategies Seminar with Dr. Jeffrey Hanson. I just want to do a quick introduction of Dr. Hanson before turning the program over to him. He taught at Michigan State before going into the administrative side of education, where he was the Director of Financial Aid at the Chicago campus of Northwestern. He managed all of the various professional schools. He also worked with Access Group, but he has been an independent consultant for 10 years, and Mercer Law School is always pleased to have him on campus when that's an option and remotely through Zoom like now when that isn't. So thank you all for participating. At this time, I'm going to turn the presentation over to Dr. Hanson.
Thank you, Lindsay. And I'm going to share my screen so that everyone can see the presentation. And Lindsay is going to distribute this information to you electronically through the school's website. So just know that all the information that I'm going to be referring to, including the slides that you're able to look at, will be posted to the law school website so that you can get copies of them as we're going through the time period. Today, we're here to really talk about loan repayment strategies. If you're attending this seminar, I assume you either do or plan to be borrowing federal student loans to pay for this investment in your education. And that, in essence, is your education mortgage. And with federal student loans, you have a lot of flexibility when it comes to the repayment of the loans. And so it's important to make well-informed decisions and to be thinking strategically as you're planning for and managing the repayment of the loans. And by strategic, I mean that in repaying your student loans, you want to make sure that in making the decisions you make, you want to try to make sure that you're making the best use of every dollar you have. Because I assume that's important to you. It's certainly important to the law school. So what we want to do today is to focus on what is the information you need to make well-informed and strategic decisions about how you plan for and manage the repayment of your federal student loans once they're in repayment. And I realize we have some individuals on the webinar who are not yet in law school, some who are currently students, and some who have graduated. But I think the information will be helpful to all of you, regardless of what stage you are in your education and in the financing of your education. Because once you finish your education, you've got to be ready to begin repaying the loans you borrowed, and you need to develop a plan so that you're in control of the process. And although the federal government will require you to complete exit counseling before you actually enter repayment, the exit counseling really focuses on simplicity and guaranteeing that you'll pay the government back on time. It doesn't really focus on making well-informed and strategic decisions in the sense that it's not focused on trying to make sure you're making the best use of every dollar you have and you're considering all of your financial planning needs as you're repaying your loans and not focusing only on the loans themselves. It's very important to the law school, though, you take a more robust, more global perspective and think about all of your financial planning needs as you consider the decisions you're going to have to make when repaying your loans. And that's really the focus of my presentation today. So let's get started. The first is that we have some exciting news. Sorry. The CARES Act, which is the stimulus package that was signed into law 2 weeks ago last Friday, had several student loan provisions. So we want to make sure you understand what those provisions are and to what extent they might be affecting you right now. For all federal student loans that are owned by the U.S. Department of Education, which includes all direct loans, including the direct subsidized loan you might have borrowed as an undergraduate, the direct unsubsidized loans that you will be borrowing or did borrow at the law school, the direct Grad Plus loans that you might also be borrowing while you're in law school, and the direct consolidation loan. For any loans currently owned by the U.S. Department of Education, interest is being waived until September 30th. So effective March 13th of this year and through September 30th, all interest is suspended from accruing on the loans that are owned by the Department of Education, including all direct loans. Regardless of whether you are in school or in repayment, interest is being waived. And that happened automatically. There is nothing you would need to do to get that suspension or waiver of interest. In addition, any loans owned by the Department of Education that are in active repayment during the period of time from March 20th until September 30th will be placed on an administrative forbearance for the 6 months during that period of time, thereby suspending repayment on those loans until September 30th. And that is, again, automatic. So if you have loans that are actively in repayment, which current law students do not, but anyone who has graduated from law school or who has not yet entered law school may have direct loans actively in repayment. Those loans were placed into an administrative forbearance and will continue to be, payments will be suspended until September 30th. And again, that has been done automatically. Those months, while you're on that administrative forbearance, will count as qualifying months toward all forgiveness benefits, including Public Service Loan Forgiveness, or PSLF. So you do not need to continue making payments on your loans for those months when they're in the administrative forbearance to be eligible for and counting towards qualifying months for any forgiveness benefit. And you will have to contact your loan servicer if you want to opt out of this administrative forbearance. And I'm not sure that you really need to do that because you're not having to pay anything. No interest is accruing. The months are counting towards forgiveness, and nothing is preventing you from voluntarily making payments on the loans if you want to. And for more updates about the federal government's response to the COVID-19 pandemic regarding student loans, they're posting all information at studentaid.gov/coronavirus. So Lindsay, let's stop just for a minute to see if anyone has any questions about the student loan provisions of the CARES Act.
No questions so far.
Okay, very good. Well, then let's move on to thinking about repayment and what steps you're going to need to take to make well-informed decisions. The majority of law students today now graduate with an educational mortgage. And that's how I encourage students and graduates to think of this debt they've incurred to make this investment in themselves. You borrowed the money to go to law school because you had to, not because you wanted to. You were eager to get a law degree because you were passionate about doing something that required that degree, but you hadn't had the opportunity to save up enough money to pay for it yourself. And that's true for over 90% of law students today. Over 90% of law students today are borrowing some amount of money to pay for their education. Now, that's exactly the same reason people take out a mortgage to buy a home. They recognize there's value in owning their own home, and they want to own their own home as soon as they can, but they haven't saved up enough money to pay for it yet. So if they can borrow the money, as long as in borrowing that money, it doesn't put them at too much risk or in jeopardy of getting into trouble financially, and as long as the cost of borrowing the money does not exceed the benefits they expect to derive from that investment, then it can make sound financial sense to borrow the money to make that investment. Well, the same really applies here for your education. I'm assuming you're eager and were passionate about doing something that requires a law degree, but you haven't had the chance to save up enough for it. Well, as long as the risk of borrowing the money doesn't jeopardize your ability to manage repayment and do the things you'd want to do financially, if it doesn't create barriers to doing the things you want to do, and if the cost of borrowing the money doesn't exceed the long-term benefits you expect to derive, then once again, it can make financial sense to have borrowed the money to get your education, in essence, to have taken out that educational mortgage. And essentially, you financed an investment in yourself, and you can be successful in repaying this mortgage without having to sacrifice your career aspirations or the achievement of your other financial and personal goals. But you must make smart, strategic, and well-informed decisions about how you plan for and manage repayment of your federal student loans. And that's really what we want to focus on today. Number one, what are the decisions you're going to have to make as you transition into repayment? And then secondly, what information you need to make sure you're making the best decision, the decision that's going to result in the best possible outcome for you and will result in your making the best use of every dollar you have. Well, you do have choices. There are decisions to be made once you enter repayment on your loans. You have to decide, are you going to refinance your existing federal student loans with a private loan if you can get a lower interest rate? And my guess is that you're likely going to be able to do that, that your credit score and your income will be sufficient, that there will be private lenders that would be willing to offer you a private loan at a lower interest rate. But the question becomes, is that a good idea? Should you do it? Normal conventions would say that yes, if you can lower the interest rate on the loans, that must be a good idea. Well, in reality, it may not really be in your best interest. You may actually be worse off because you've refinanced your federal loans with a private loan. But clearly, that goes against conventional wisdom. So what else do you need to know in order to evaluate whether or not this is the right decision for you? We want to make sure you understand and know what information you need. So we want to talk about that. If you do not refinance your federal loans with a private loan, then you could consider consolidating them or refinancing them with a different federal loan, the Federal Direct Consolidation Loan. The only likely benefit you would get from doing that is if you have non-direct federal loans, such as a Perkins loan. So again, we want to make sure you understand under what circumstances might it make sense to refinance your existing federal loans with a different federal loan, given that in doing so, you're not actually going to lower the cost of the debt. Because of how the interest rate on that new Federal Direct Consolidation Loan will be calculated, you're actually going to increase the interest cost just a little bit. So what would be the benefits or the reasons you might choose to do that? Well, we want to make sure you understand that. Again, if you do not refinance your federal loans with a private loan, then you have to decide what payment plan are you going to choose, at least initially, to repay your federal student loans, because there currently are 9 different payment plans available to individuals who have borrowed federal direct loans. So you have to decide what specific plan you should at least start with, recognizing that you can always voluntarily pay extra at any given point in time without penalty, and you can switch from one payment plan to another over time as your financial circumstances change. So we want to make sure you understand what should you be considering when picking the payment plan initially that you will start with, and then under what circumstances might you consider changing plans over time. And finally, regardless of whether you refinance your federal loans or not, should you pay off this student loan debt as fast as possible? Conventional wisdom would suggest that yes, the sooner you pay off the debt, the sooner you'll be out from under this burden, and the sooner you'll stop accruing interest on the debt. So you might think that yes, that is a good idea. Well, once again, though, financially speaking, it may not actually be in your best interest to be paying off your federal student loans as fast as possible. But again, that does go against conventional wisdom. So we need to make sure you understand what are the reasons why you might not want to pay off the loans as fast as possible, and what are the considerations you should have. So that's really what I want to make sure we cover in the next 45 minutes of this presentation. But before we do, I do want to address the elephant in the room, the reality that this is debt. And normally with debt, you feel as though you've boxed yourself into a corner from a financial perspective. Another way of thinking about it, you normally feel as though you've dug yourself into a hole. And why is that? Well, it's because normally when you have borrowed money, your payments are locked in at the time you borrow the money because they're based upon how much you borrow and the terms you agreed to at the time you borrow the loan. And that creates a fixed monthly obligation, an inflexible amount, and it's based on the amount you owe, the amount of your debt, not on your ability to be repaying that debt as you are in the process of repayment. And yet over time, your financial circumstances could change, causing you to potentially have trouble making that locked-in, inflexible monthly payment. Because the payments get locked in at the time you borrow the money, typically, that puts you at risk and limits your options financially. It puts you at risk of having to miss the payment due to a loss of income or an unexpected expense. Because if you have a loss of income or an unexpected expense, and now as a result of that negative change in your circumstances, can't afford that fixed monthly obligation, then your only option is to miss it, and you know bad things would happen. And of course, that's a concern. That's something you worry about because we all face financial uncertainty and risk in our lives. But having that debt also limits your ability to pursue the job you want. Because if you have this fixed monthly obligation, you've got to make sure you're earning enough income to cover that monthly expense as well as all of your other expenses. It's not going to be based on what you can afford to be paying. And that would be unfortunate if in borrowing money for your education, you couldn't pursue the career you wanted. You couldn't afford to take the job you want. It also limits your ability to be investing for retirement, building financial security for the future, and it certainly would be limiting your ability to buy a house in terms of saving for the down payment and qualifying for the mortgage. So they're just examples of how debt typically is also potentially creating financial barriers. So these are certainly reasons that you'd be concerned about and worried about having debt, and why you would feel as though you've dug yourself into a corner or boxed yourself into a hole or dug yourself into a hole. Again, you're concerned about the risk and the potential that that debt's going to limit your options. Well, with federal student loans, you don't need to feel as though you've boxed yourself into a corner or dug yourself into a hole. So what is it about federal student loans that makes them different from all other forms of credit, including a private student loan? Well, federal student loans offer choice, flexibility, and safety. They offer a choice of payment plans. And even once you pick a payment plan, you're not locked in. You can switch from one plan to another over time. So that provides you with continual flexibility over time. As your circumstances change, you have the flexibility to make adjustments in terms of what you have to be paying each month. But most important is that with repayment of federal student loans, the structure of repayment has built-in safeguards, really provides a safety net. And what really provides the safety net is the income-driven repayment structure. So it's very important to understand how federal student loans are different from other forms of credit, including a private student loan. And the important difference is that payments can be based on your income rather than on the amount of your debt. And with the current income-driven plans as it is today, your payments can be equal to as little as 10% of your household's discretionary income. And therefore, you could have 90% of your household's income left over every month for everything else, regardless of the amount of your debt. Now, we're going to define what household discretionary income is in a few minutes. But the point here is that with federal student loans, you've got a built-in safety net. It's designed to try to protect you from the risk you'd normally associate with having debt. Because with federal student loans, because of the income-driven repayment structure, you should never have to miss a payment or default on a federal student loan because you've had a loss of income. Because if you had a loss of income, you could immediately get your monthly payment reduced to reflect that loss of income. And it would be reduced proportionate to the reduction in income. And so hopefully you would still be able to afford whatever that monthly payment was. And if for some reason you had no income, the monthly payment would be zero, and that would not be negatively affecting your credit. Well, from a risk perspective, that makes your student loan debt even less risky than your living expenses. Because if you had a loss of income, the one expense that could immediately adjust proportionate to that change would be your monthly payment on your federal student loans. But your income, the expenses you have, rent, food, transportation, and so forth, your living expenses could not as easily adjust. So even your living expenses potentially create more financial risk to you due to uncertainty than do the federal loans you borrowed. And yet normally you would never characterize debt as being less risky than your living expenses, but because of the income-driven repayment structure, that really provides you with that safety net. And the point is that you'd be giving up that safety net if you refinanced your federal loans with a private loan. You'd in essence be jumping back into that hole, boxing yourself back into that corner. So you want to be very mindful that that would be an added difference between the federal loan and the private loan. The only difference, that's a difference that matters just as much potentially as the difference in the interest rate. So you want to be mindful of that. It's also the case that the income-driven repayment structure is trying to address the issue of the debt preventing you from being able to do other things. Because as a result of the income-driven repayment structure, you're basically guaranteed of always being able to have at least 90% of your income available for all the other expenses and financial needs you would have. And if that's basically enough for everything else, if that's not in a significant way limiting your options, then it's not really in a significant way creating barriers. So as such, federal student loans need not box you into a corner financially. They provide financial safeguards, particularly because of the 10% income-driven repayment structure, that greatly reduce or minimize the risk and the financial barriers you normally would associate with having debt. And typically those are two very important concerns you have when borrowing money. But of course, the other concern is the cost. Well, making informed decisions about how you're going to manage repayment of your loans also requires understanding the total cost of debt. And whenever you have debt, you're always incurring two costs. There's the interest you're being charged, the interest you're paying, but then there's also, in essence, the interest you are losing. Because whenever you have debt, there's always the direct cost, the interest and fees you're paying for the right to have borrowed someone else's money. And clearly you want to minimize that cost to the extent you can. And the interest rate and the rate at which you're paying back the loans certainly directly impact that direct cost. But there's also the opportunity cost, the value of what you're foregoing to repay the debt each month. Because as you're repaying the debt, whatever amount you're paying, you're foregoing the opportunity of being able to use that money in other ways. And yet, you could have invested that money in your retirement plan where you were earning interest. You could have been saving that money so you more quickly had the cash necessary for the down payment and the closing costs to buy your own home. You could have saved that money so you had an emergency fund so that if you did have a loss of income or an unexpected expense, you would have the resources available to cover all those other expenses for which there isn't the built-in safety net that comes with your federal student loans. So to the extent that the cost of the debt influences your decisions about how you're going to approach repayment, both in terms of potentially refinancing, but also in terms with regard to the speed with which you're paying back the debt, you want to make sure that you're not focusing only on the direct cost, the benefit you would derive from reducing the direct cost. You want to also be mindful of the opportunity cost, because in lowering the direct cost, you will most likely be increasing the opportunity cost. And if you're increasing the opportunity cost by more than you've lowered the direct cost, then from a net cost perspective, you are actually worse off. And that's not likely what you were intending to do. There's another factor you need to consider when it comes to the cost of the debt, and that's the difference between simple and compounding interest. Simple interest is interest that accrues in a linear manner over time because it is not being capitalized. It's not compounding. In other words, it's not being added to the principal balance. It's accruing, but then it's just sitting there or it's getting paid. And the interest generally accrues on your federal student loans as simple interest, both during school and in repayment. There is one point in time when the interest that's accrued on your federal loans will get capitalized or added to the principal balance. And that will be when the loans go into active repayment. In the case of your loans from law school, that will be 6 months after you graduate. But then from that point forward, once you're in repayment, you'll either be paying all the interest as it's accruing, or perhaps not, because with income-driven plans, we allow for the possibility that you can't afford to be paying all the interest that's accruing, in which case it's just going to start piling up again. But the interest on your student loans is generally increasing in a concave manner over time, linear or in a straight line until you start reducing the principal balance. Then once you start reducing the principal balance, it keeps increasing, but at a decreasing rate. Now that's in contrast to compounding interest. With compound interest, it increases exponentially over time because it is being capitalized or added to the principal balance. And interest is compounding, perhaps as often as daily, on your investments. And so your money is growing exponentially. So as such, you could end up with more money, not less, by investing your extra funds rather than paying off your federal student loans faster, in part because in the difference of how these growth curves behave. The compounding interest curve would eventually intersect and exceed the simple interest curve, such that you could end up with more money in the bank, not less, by choosing to take longer to pay back the loans. The choice is yours, but you just want to recognize that it's very important to consider these differences when considering the cost aspects of the debt. So what should you do when mapping your course for loan repayment? Before we address that question, let's stop quickly to see, are there any questions or comments about what I've just reviewed? Because that's information that you're not going to hear in exit counseling.
No questions.
All right. So then, what should you do to map your course for repayment? Well, should you refinance your federal loans with a private loan? Well, you have the right to do so. And I suspect, as I said before, that your credit score and the amount of your income will be sufficient that you likely could get a private loan at a lower interest rate. But you will lose the choice, flexibility, and safety provided by the federal student loans, including, in particular, the income-driven repayment options. You won't have the flexibility to have your payments adjust over time according to how your income is changing. And in fact, you'll have a locked-in fixed monthly payment that will become completely inflexible. So though you may lower the direct cost, because in lowering the interest rate, you are reducing the direct cost, you likely will increase the opportunity cost, because it's very likely that you will have to repay the private loan faster. You won't have the choice to pay it back more quickly. You'll be required to pay it back more quickly, because the only way that lender could offer you a lower interest rate would be to get you to pay them back more quickly, so that they're making sure they're covering their opportunity cost associated with loaning the money. And therefore, if you have a higher monthly payment as a result of, because you'll have a higher monthly payment as a result of having to pay back the debt more quickly, then although you've lowered the interest rate, you've increased the amount of income you have to be paying towards the loans each month. So you've increased that opportunity cost. You're diverting more of your income than you would have had to the repayment of the debt, and away from the opportunity to be doing other things with it. So you actually may be worse off from a cost perspective. And you're definitely worse off from a risk and from a limiting aspect perspective. You just want to recognize you may be giving up more than you're gaining if you borrow a private loan. So exercise caution, be fully informed, investigate all of the differences between the private loan and the federal loans. Don't focus solely on the interest rate. If this is something you're interested in doing, then sure, go ahead and apply for the private loan, but apply through several different lenders to shop around. But then make sure you compare how are the terms of that private loan different. In particular, what will be the differences in the monthly payments? Because once you examine all of the differences, I suspect you'll conclude that refinancing your federal loans with the private loan is not really going to give you a better situation. And you want to make sure you're making well-informed decisions. In my opinion, as an economist, as a financial aid, student loan and debt management expert, given the amount that law students typically are borrowing today, given the interest rates on federal loans versus private loans and the terms offered on private loans today, it would be my guess that you're not going to get a better deal when you consider all of these differences. But it is not my opinion that matters. What matters is that you make a well-informed decision and you can make sure you're comparing all of the differences. So Lindsay, any follow-up questions to this decision or this issue?
None.
All right, so moving on, assuming you don't refinance with a private loan, should you consolidate or refinance your federal loans with a different federal loan? And consolidating debt is the refinancing of debt. It is not the combining of debt. You're borrowing a new loan, in this case, a new federal loan called the Federal Direct Consolidation Loan. So it would have the same lender, it just is a different loan. And it may be helpful, particularly if you have non-direct federal student loans, such as the Perkins loan. But it's not likely necessary, at least when you first enter repayment, if you only have borrowed direct loans. And you've only been borrowing direct loans, or you'll only be borrowing direct loans while in law school. And you cannot consolidate or refinance private student loans in the federal loan program. Now, all federal student loans are eligible, but in refinancing your federal loans with the Federal Direct Consolidation Loan, it does not lower the cost of the debt because the interest rate on the new loan would be fixed and it would be equal to the weighted average of the interest rates of the loans being consolidated, but then that weighted average is rounded up to the nearest 8%. So it actually slightly increases the interest expense. Now, one of the documents that was provided to you for this lecture is the loan repayment planning worksheet that I use when I meet with individual students and borrowers. And the fourth step of that action plan on the fourth page really gives you a full explanation of consolidating debt, both from a federal and a private perspective, and explains all the factors you need to consider. This also becomes a reason why you might want to meet with me individually. It doesn't cost you anything. It's a service the law school provides to you. So if you're interested in meeting with me individually, make sure you contact Lindsay to arrange for an appointment. Apply for the new loan at studentgate.gov if you decide it's the right action to take. But the earliest you could do it is after you've graduated and the loans are transitioning into repayment. Any questions about the Federal Consolidation Loan Program, Lindsay?
No questions.
All right. So then again, assuming you do not refinance your federal loans with a private loan, then you're going to have to decide on what payment plan to choose. And here, I think the decision is clear if you're being strategic. And remember, by strategic, we mean you're trying to make the best use of every dollar you have. So if you're trying to do that, which I assume you are, you'd want to consider choosing the payment plan that offers the lowest scheduled or required monthly payment, because you can always pay extra and you can change from one plan to another over time as your financial circumstances change. By using this strategic approach, it provides you with maximum cash flow flexibility. In other words, it allows you to retain the greatest amount of control in terms of how you get to decide how you spend your money. And I would assume that you want to be in the driver's seat. You want to be in charge of how your money is getting spent. And so choose the plan that gives you the lowest required monthly payment, because then you can decide if you want to pay off the debt more quickly. You can do so in a way that maximizes the amount you're prepaying in a targeted way at your most expensive debt. The typical law student graduates with multiple federal loans, and those federal loans end up having different fixed interest rates because of federal law and because of how the rates are adjusted each year due to the 10-year Treasury note. So ideally, in paying off your federal student loans, it would be best if you were maximizing what you were paying each month at the one loan that had the highest interest rate and minimizing what you're paying towards all of the others, because that would give you the greatest bang for your buck in terms of how you're paying the loans back. And once your loans enter repayment, which after law school is 6 months after you graduate, you have to start paying back every loan every month. You can't choose to pay them back one at a time. The only way you can target payment amounts at a specific loan is to be paying extra, paying above over the amount that's required by the plan you've chosen. So even if you wanted to pay off the loans more aggressively, it still would be best to minimize what you have to be paying that will be applied proportionally to the balances of each of your loans, because that required payment amount will represent the sum of the minimum payments you owe on each of your loans that month. And you don't have any control over how that payment is applied. It will be applied proportionally to the balances of each of your loans. It's only if you're paying more than that amount, paying extra, that you can target the extra amount at a specific loan. Still would have to pay any outstanding interest before principal, but at least could be applied at your most expensive loan, which will be your Grad Plus loans. Those are going to be more expensive because the interest rate on the Grad Plus loans are always 1% higher than the corresponding rate on the unsubsidized loan you borrowed in the same academic year. But furthermore, what if you have other debt? What if you have credit cards? What if you have private student loan debt? Then clearly that's even more expensive debt and more risky debt. So again, by picking the payment plan that gives you the lowest required monthly payment, it allows you to be as targeted as possible when paying back your debt so that you can make sure you're making the best use of every dollar. It also allows you then to have the flexibility to decide if you want to allocate or spend that extra cash in other ways. For example, investing or saving for the future. And so that brings up the question, should you be paying off your federal student loans as fast as possible? Well, you have the right to do so. There are no prepayment penalties, but faster may not be better. You may want to consider taking a longer approach to repaying your federal student loans because you may have better uses for your extra funds in terms of opportunity cost. So what are the other potential uses you might have your money? Well, you must decide how to allocate your funds, particularly once you're earning income, across what I refer to as the 4 buckets: the past, the present, the future, and philanthropy. The past is what at a minimum you're having to pay on your debts each month. The present is what you're choosing to pay on your living expenses. The future is what you're saving or investing now for future anticipated expenses, like retirement, the purchase of a new home, your children's education, and emergencies. And then philanthropy is the money you're wanting to contribute charitably to various organizations. What you want to be mindful of is that typically while you're in school, you're ignoring the future bucket. But it's a bucket you can't afford to be ignoring once you're earning income. And although I'm not a certified financial planner, I'm an economist and a student loan, financial aid, and debt management expert, I would agree with what financial planners suggest. And they would suggest you should be paying yourself first, and you should be paying yourself at least 20% of your gross monthly income, because you need to be investing for retirement. And ideally, you'd want to be investing a minimum of 10% of your gross monthly income, because I assume that you hope to retire someday before you die. And if that's true, then you're going to have saved the money you're going to need to live on once you're no longer earning income. And you're also going to want to save for a rainy day, the emergency fund. And what's recommended here is that you'd want to save anywhere from 6 to 9 months of your monthly living expenses, so that was available to you should there be any kind of emergency that might arise, such as the COVID-19 pandemic. What about saving for the down payment and the closing costs for your own home? Again, you're going to need money for that purpose. And unless someone's going to give it to you as a gift, you're going to have saved it. And what if you plan to have children, or you already have children? How are you going to be paying for their education? Again, the sooner you start saving for their education, the more flexibility, the more freedom you'll have to choose the options for them, and and that reduces the probability that they'll have to borrow loans themselves. So you want to recognize you have other financial planning needs for your resources besides paying off your student loans. So you want to make sure you're not overlooking these other needs at the same time you're paying back your loans. You want to consider a more balanced or more leveraged approach, because one of the things that you want to be mindful about compounding interest in terms of your investments is that it's not just that the interest is compounding, but it's also important to be aware of how quickly and the timing of that investing. And the way I can illustrate this is with the following example. Let's suppose we had two individuals, both of whom just turned 20. Their birthdays the same day, and on their birthday, they both started working at the same company. That company gave them the opportunity to be investing in their retirement plan, a 401k. Now, the first individual opted to start investing that very first month, and she was investing $200 a month, every month, for 10 years until age 30. Then for some reason, she stopped investing any additional money. She just let the money grow through compounding interest in her retirement account until age 65. Her colleague waited for 10 years. He started investing $200 a month at age 30, and he continued to do so until age 65. They invested in exactly the same way. Now, the first individual invested a total of $24,000 of her own money, $200 a month, every month for 10 years. But she started doing so at age 20. The second individual invested $200 a month for 35 years. So he invested $84,000 of his own money, or $60,000 more, 4 times as much. But he waited 10 years to start investing the money. Now, at age 65, which person likely had more money in the bank? You might think it was the second person because he invested 4 times as much. But in reality, it was much more likely the first person. Because although she invested a quarter as much, she started investing 10 years sooner. And it's the timing of when you're earning compounding interest is equally important with the rate at which you're getting a return. And law students are more like the second person, because while you're in law school, you're not earning income, at least not very much, and therefore you're not really investing the way you could have been if you were working full time. So what you want to recognize is you've already set yourself behind. You've already created a situation where you're going to have to invest more of your own money in order to be able to afford to retire. Now, you'll likely be able to afford to do so, but it will come at a cost. It means you'll have to be giving up other things at that time in order to save the amount you need. And the faster you pay off your loans, the more you are exacerbating that situation. So my point is, you just want to make sure that you're considering both sides of the cost equation when thinking about how you're going to pay back your loans. Paying off your loans faster will clearly reduce the direct cost because it will lower the total interest expense on the debt. But it simultaneously increases the opportunity cost because you're diverting more of your income to the debt and away from the opportunity to be investing and saving in that future bucket. So therefore, when repaying your federal student loans, you need to evaluate this trade-off between the direct and the opportunity costs, as well as the difference in simple versus compounding interest, so that you're making an informed decision that meets all your financial needs and allows you to be strategic in that it hopefully allows you to make the best use of every dollar you have. So now let's take a brief break and see, are there any questions at this point?
No questions.
All right. Well, then we've covered the information that I think you need to make well-informed decisions, the factors you need to consider that really typically are not brought up or discussed as part of the exit counseling, that allow you to make much more informed decisions with regard to the risk, the limiting aspect, and the cost of the debt. But now we're left with the decision, all right, if I should pick the payment plan that gives me the lowest required monthly payment, then what plan will that be? Well, let's briefly review the plans. The plans fall into 2 categories when repaying subsidized, unsubsidized, Grad Plus, and consolidation loans. There are the traditional plans, the installment plans. Here your payment is based on the amount of your debt, and there are 4 plans currently: the standard, the graduated, the extended fixed, and the extended graduated. Then there are the income-driven plans, the plans that what make federal student loans unique, that provide the flexibility, but more importantly, the safeguards. Here your payment's based on your income, and it can adjust over time according to how your income might change. And there are 5 plans currently: revised pay-as-you-earn or repay, the newest plan; pay-as-you-earn or payee, its precursor; 2 income-based repayment plans, or 2 IBR plans; and then the original income-driven plan, income contingent repayment, or ICR. For the installment plans, the payments are based on the amount of your debt, and they're based on an amortization schedule. In other words, they're based on a schedule that calculates how much would you have to pay each month to get all the debt killed off or paid off in a finite number of monthly installments. where you're having to repay all that you borrowed plus the interest that accrued in some specific period of time. And there are 4 plans: the standard, the graduated, the extended fixed, and the extended graduate plan. And with these plans, at a minimum every month, your monthly payment must at least equal the accrued interest each month. So it has to cover all of the interest that accrued that month. In other words, negative amortization is not permitted in these plans. Now, the strategic choice would be the plan that gives you the longest period of time and the lowest monthly payment. Because the longer you have to pay back a loan, the less you have to pay each month. And the minimum amount you could be paying under these 4 plans is the interest. So the strategic choice of these 4 installment plans would be the extended graduated plan. Because with that plan, the payments increase in graduated steps every 2 years, and they start out as interest-only payments for the first 2 years. So that's the lowest possible monthly payment option you would have of the installment plans. Now, you want to be aware, though, that the default plan, the plan you're on if you don't opt into a plan, is the standard plan. That's the 10-year fixed option. Well, you could choose to pay off the debt in 10 years, but with the standard plan, that would be maximizing the amount you're paying towards each of the loans, which would be the opposite of the strategic approach. That would give you the least control over your money. And I think you want to have the greatest amount of control. So the strategic approach is the extended graduate plan. And then if you want to pay off the debt in 10 years, just aggressively pay extra each month in order to get the debt paid off in 10 years. But it allows you to target the extra amount you're paying at your most expensive loan. So you'll end up paying even less interest than if you're on the standard default plan. Any questions about the installment plans, Lindsay?
No questions.
All right. With the income-driven plans, your payments are based on your income. And here we're going to define what's meant by household discretionary income. The payments are based on a percentage of your household's discretionary income. And that represents that portion of your household's adjusted gross income, or AGI, that exceeds 150% of the federal poverty guideline for your family size and state of residence. Because in essence, what the government's trying to provide to anyone who's borrowed a federal loan is the opportunity to have an affordable monthly payment based on their household's income and expenses and without regard to the amount of their debt. Household adjusted gross income always includes your income. And if you are married, it also includes your spouse's income if you file a joint federal tax return. You could exclude your spouse's income if you file separate federal tax returns if using the pay-as-you-earn and the IBR plans. But spouse's income is not excluded when using the revised pay-as-you-earn repay plan or the original ICR plan. Now, family size does not depend upon how you file your taxes. It always includes you. It includes your spouse if married, even if you file your taxes separately. It includes your dependent children and any other dependents. And with the income-driven plans, where we're trying to provide you with an affordable monthly payment, then your payments get adjusted every 12 months based upon how your adjusted gross income and family size have changed during the prior 12 months. And unlike the installment plans, and unlike other forms of debt, like the private student loans, with the income-driven plans, we allow for the possibility that your payment can be less than the accrued interest each month. In other words, we allow for negative amortization. This is the one case in federal credit law where negative amortization is permitted, because the whole purpose of the income-driven plans is to try to provide you with not only an affordable monthly payment that's allowing you to comfortably be making your student loan payments as well as accomplishing the other things financially, but so that it's also not creating financial hardship. And given the amount of your income and the amount of your debt, having to pay all the interest might in fact create financial hardship. So we allow for the possibility that you can't afford to be paying all of that interest. And there are 5 income-driven plans. And the 2 I want to focus on are the 2 newest plans, Repay and Payee. Revised Pay-as-you-earn and Pay-as-you-earn. They're the 2 10% options that almost all direct loan borrowers today are eligible to use. Everyone is eligible to use Repay, and anyone who was a first-time borrower on or after October 1st of 2007, or if they had loans prior to that date, those loans were fully repaid before they borrowed their first loan, on or after that date, are eligible for these 2 plans. And with these plans, your payments would be based on the smallest percentage of income. And with these plans, it's possible that your monthly payment wouldn't be covering all the interest that's accruing. And with these plans, because you're not necessarily paying all the interest that's accruing, then it's possible that the debt could be out there for a very long period of time. So there's the possibility of forgiveness. And this is not related to public service. This is simply because you've been in repayment for a long enough period of time. So with Repay, it would be after 25 years of making income-driven payments. If it was pay-as-you-earn, it would be after 20 years. But you could always switch from Repay to Payee as late as the 19th year and the 11th month, make one more payment, and get the debt forgiven in the 20th year under pay-as-you-earn. So the fact that pay-as-you-earn allows for the possibility of debt being forgiven 5 years sooner doesn't mean you have to start out in pay-as-you-earn. And although the payments could get capped at the standard 10-year payment amount, if you're not experiencing a PFH or partial financial hardship, again, that wouldn't be a reason to choose pay-as-you-earn initially. The reason why you'd want to choose a particular plan, particularly if these two plans gave you exactly the same monthly payment, which they will, as long as you're single or you're married filing jointly. The only time when these two plans would give you a different monthly payment is if you're married but file your taxes separately. Then under pay-as-you-earn would be excluding your spouse's income, and assuming your spouse had income, then pay-as-you-earn would give you a lower monthly payment than Repay. But the difference in these two plans that matters when you first enter repayment is the subsidy feature. So let's talk for a minute. The subsidy occurs during periods of negative amortization. In other words, it occurs whenever the amount of your scheduled payment under the income-driven plan is calculated to be equal to less than the interest that's accruing on the loan that month. In that case, on unsubsidized loans, which are the loans you borrowed or borrowing in law school, the government would be subsidizing or waiving 50% of the amount of interest that wasn't getting paid through the plan if you're on Repay. If you're on pay-as-you-earn, you wouldn't be getting that benefit. And if you have subsidized loans from undergrad, the benefit would be the same. Well, an easy way to understand the benefit is to look at the following example. Let's suppose that you ended up owing $120,000 in federal loans at the time you entered repayment, 6 months after you graduate. And all of those loans were unsubsidized, a combination of the unsubsidized direct student loan and the direct grad plus loan, which is also an unsubsidized loan. If we assume the weighted average interest rate on the loans was 6.7%, then the amount of interest accruing on the $120,000 would have been about $670 a month. And that coincidentally happens to be what the initial monthly payment would be under the extended graduated plan, the strategic choice of the installment type plans. Now for the income-driven plans, the payment would be based upon your adjusted gross income, AGI, your household or family size, your state of residence, and the poverty guidelines. So if we assume your adjusted gross income was 0, then your monthly payment would be 0. The amount of interest going unpaid was the full amount, $670. But with Repay, the government would have subsidized or waived half of that amount, or $335. So after the first 12 months, you'd have over $4,000 of subsidy. In other words, $4,000 less interest would have accrued to you, which is equivalent essentially to having $4,000 of interest forgiven tax-free in that first 12 months. Now, conversely, if your adjusted gross income was $35,000, then your monthly payment would be $132 a month. The amount of unpaid interest would have been $538, the subsidy $269, and the total subsidy over the 12 months would have been $32.28. So hopefully this illustrates why, if Repay and Payee were giving you exactly the same monthly payment, and that was less than the interest that's accruing, then you'd want to choose Repay over Pay-as-you-earn because it would give you the same monthly payment, the same lowest opportunity cost, but it also would coincidentally be lowering the direct cost of the debt because some of the interest that should be accruing to you is getting waived or subsidized. So Lindsay, any questions about these plans?
No.
All right, then let's move on. So here's a chart that simply compares what the monthly payments would be under the two 10% options we've been discussing, Repay and Payee, based on different levels of adjusted gross income and household or family size, and the standard default plan. So I encourage you to take a look at that chart. But you also could actually calculate the monthly payments using a tool that the government provides. It's called the Loan Simulator, and it's available to you at studentaid.gov. But I want to caution you, the purpose of this tool is not really to give you monthly payment estimates. Its purpose is to really give you a recommendation as to what plan you should choose. So we want to talk about that. But here is how the results would be displayed. For each of the plans, they would provide you with the name of the plan, the first and last monthly payment, the initial and final payment estimates, assuming you started and stayed on that plan throughout the life of repayment and did not pay anything extra. It gives you an estimate of the total amount paid, again, assuming you stay on that plan throughout the life of repayment and don't pay anything extra, an estimate of when the debt would be paid off, and an estimate of the amount of debt that might have been forgiven, and other information about the plan. But there's a couple of comments I have with regard to using the simulator. All the estimates assume a very simplistic approach to repayment. In other words, the idea that the government wants to make it as easy as possible for you to pay them back on time. So they assume you will never change plans, that you'll remain on the same plan throughout repayment, and they assume you'll never pay extra or prepay on the debt. All right? Well, I think you want to use a more strategic approach. Be willing to change plans. Be willing to pay extra amounts, because that'll allow you to make better use of your money. But the estimates provided also cannot be compared, particularly when it comes to the total paid amount. You cannot compare the total paid estimates for the different plans because they do not take into account the time value of money or inflation. They're not present value estimates, and they don't take into account opportunity cost, the value of what you're foregoing each month as you repay the debt. As such, comparing the total amounts paid over different lengths of time, 10 years versus 25 years, and over different structures, fixed versus graduate, is not an apples to apples comparison. And so although the government might encourage you to compare the amounts, you can't draw any valid conclusions about which plan would actually be the least costly. In reality, the standard plan, which might appear to be the least costly, could be the most costly when you consider the impact of inflation and opportunity cost. They also, the final payment, months in repayment, total paid, and amount forgiven estimates for all of the income-driven plans are based on unrealistic assumptions. Household adjusted gross income is assumed to increase annually by a fixed percentage amount, the same amount every year on a percentage basis. Well, that's not realistic. And the family size is assumed to remain unchanged during repayment. So that may not be realistic. So the bottom line is that in comparing the numbers provided to you with the loan simulator, the only estimates that you can compare where you can draw a valid conclusion about the differences are the initial or starting monthly payments. All other estimates, including the total amount paid and so forth, are based either on unrealistic assumptions or don't take into account all the factors they should. So I'd encourage you to be very careful. And that would be true with any loan repayment calculator that you use that gives you estimates of the monthly payments for federal loans. The only estimates you can really compare are those initial monthly payments. So be strategic in repayment. Develop a plan for repaying your federal student loans. And that's why we've provided you with that loan repayment planning worksheet. It allows you to develop your action plan in 4 steps. The first step is to take stock of your loan portfolio, to know what loans you have, what they're costing you, who you have to pay back, and so forth. And that information can all be gathered by reviewing your loan summary and loan details that are out at studentaid.gov, the main portal that allows you to see all your federal student loan information through the Department of Education. You also need to determine when repayment begins. With regard to the federal loans you're borrowing in law school, it'll be 6 months after you're no longer enrolled, at least half time. So those of you graduating this spring, it'll be in November of this year. If you have loans you borrowed prior to going to law school that were already in repayment when you entered law school, then they will go back into active repayment as soon as you graduate. But given the CARES Act provisions, that will be delayed this year until October 1st. If you had loans you borrowed prior to law school that were not yet in active repayment because perhaps you went straight from that prior degree program into law school, then you'll still have the 6-month grace period. Again, that becomes a reason you might want to sign up to meet with me individually so we can just confirm that for you. You could always also contact your loan servicer to know exactly when repayment begins. Then you need to choose your payment plan, evaluate if refinancing with a different federal loan is beneficial, and then remember you have to repay all that you owe. And who is your loan servicer for federal direct loans? Well, the direct loans are the loans you're borrowing while you're in law school, and they're serviced currently by 9 different private contractors: Cornerstone, Fed Loan Servicing, Granite State, Great Lakes, Ed Financial Services, Mohila, Navient, Nelnet, and Osla Servicing. So all of your direct loans are being serviced by one of those 9 companies, and so I certainly hope that you recognize one of them, because they've been sending you communications, likely by email, while you've been in school. Ed, or the Department of Education, will be changing, however, how your direct loans are serviced in the coming months. The Department of Education is creating its own servicing system, and once it's in place, they will be using that system to service all of their loans, they'll no longer be using these third-party contractors. And that servicing will be managed directly through studentaid.gov, and there will be a new toll-free number you would call. We don't know when that change is coming, and we don't know what that new phone number will be, and you will be notified when the change comes, so just be watching for that. And you can check your dashboard or the home page at studentaid.gov to verify the contact information for your current loan servicer of all of your federal direct loans. And picking your plan, why do you need to do it? Well, because the loans will remain on the standard 10-year fixed plan if you fail to notify the servicer of your desired plan. And that would be the least strategic approach. That's the plan that would maximize how much you have to be paying each month and give you the least ability to be making targeted payments or to have the flexibility to do other things with your money. You have to do so 45 to 60 days prior to the start of active repayment, and you should be contacted by your loan servicer when you need to confirm the plan. And although you'll indicate the payment plan you want to use as part of exit counseling in the spring semester of your final year of law school, that is not a binding decision. You'll still need to confirm your choice of plans with the servicer about 45 to 60 days before the start of repayment. So those of you graduating this spring, it'll be around October 1st of this year. How do you do it? You simply follow the directions provided by the servicer. But if you're choosing to use an income-driven plan, which I suspect that's likely where you'll start, you'll need to apply online for the income-driven plan you want to use. And the application is available online from the in-repayment checklist on your dashboard at studentaid.gov. And once you're on a plan, if you need to change plans, simply contact the loan servicer. And one quick comment about completing the income-driven plan application. You may have been surprised in the example that I used an adjusted gross income of $0 and $35,000. You might have been surprised, those seemed like awfully low numbers. Well, not really, because remember, your adjusted gross income comes from your prior year's federal tax return. And it's that prior year's income figure that's to be used to calculate your monthly income-driven plan payments, unless you report at the time you're applying for the plan that you now have less income. So in reality, for the first 12 months you're in repayment on your federal loans under an income-driven plan, it's going to be the prior year's tax return that's used to establish your monthly payment. So that's why I used $0 and $35,000, because my guess is whatever you earned in the prior year before the start of repayment is going to be somewhere between those two amounts. But it's also important that those of you who are graduating this spring, you need to make sure you file a federal tax return for last year at irs.gov, even if you didn't earn enough to have to pay taxes and therefore are not required to file a tax return. Because as long as you file a tax return and therefore there is an adjusted gross income figure that exists, you can use that number to calculate your monthly payment for the first 12 months. If you have not filed a tax return, then they have to use your current income. And the application asks the following question. Has your income significantly decreased from your adjusted gross income on your prior year's federal tax return? For example, have you lost your job or had a loss of income? You should only answer yes to this question if at that point you are earning less than what you report on the prior year's tax return. Otherwise, you want to use that prior year's information. So at the time you're applying for the plan, if you're now earning more, your payments are still to be based on the prior year's tax return. And quickly, let's review public service loan forgiveness. Public service loan forgiveness is a repayment benefit that provides the tax-free forgiveness of any outstanding balance on a federal direct loan once you complete 120 months or 10 years of qualifying public service while in repayment on that direct loan. And what constitutes a month of qualifying public service are that you must satisfy 3 conditions during the month for that month to count. You must be repaying your qualifying loans, and only direct loans are eligible, particularly the direct subsidized, unsubsidized, grad plus, and consolidation loans. Must be a paid employee, generally not a contractor or volunteer, of a qualifying public service organization, which would be a government agency, federal, state, local, or tribal, or a private qualifying nonprofit, in particular a 501c3. And you must make an on-time scheduled qualifying payment using any income-driven plan. And even if your scheduled payment happens to be $0, which it might for the first 12 months, it still is considered a qualifying payment. And for more information about public service loan forgiveness, go to studentaid.gov. So let's take charge. A few final words. Remember, you're going to get a single billing statement on your direct loans. And the best way to pay it is using autopay. Sign up to have your payments automatically deducted, because then you'll also get a reduction in the interest rate. And there's no penalty for prepayments, but make sure if you're going to voluntarily pay extra, think about what you're giving up to save some interest, and then make sure you're targeting the extra amount at the loan with the highest interest rate. And remember, payment relief is available. There are important safety nets, but you've got to contact the loan servicer to get the help you need before you miss the payment. And for more information always deal directly with the loan servicer. That's who's in charge of managing the repayment process. Right now, it's one of those 9 companies, but in the coming months, it will become the Department of Education directly. And as far as getting more information, I'd rely solely on the Department of Education for your information, because they're the ones who you owe the money to. They're the ones who are in charge. So that's going to be the best source. And all of their information now has been centralized on the studentaid.gov portal. And be strategic. Take charge of loan repayment, because if you don't, it's going to take charge of you. Focus on not only your desire to pay off the loans, but also your need to achieve your other financial planning goals. Think strategically. And with that, I hope that has provided you with useful information. And now I'll turn it back over to Lindsay so she can wrap it up with a few final comments.
Thank you all for participating. I had a couple of questions. One was about the repayment plan. I had a question about, is that for new borrowers only, and what constitutes a new borrower?
Okay, repay is available to anyone who has federal direct loans. You do not have to be a new borrower. Pay as you earn, you have to be a new borrower as of October 1st of 2007. And a new borrower is anyone who didn't have loans prior to that date, or if they did, the loans were fully repaid before they took out their first new loan on or after that date.
All right, well, thank you very much. That concludes our questions. I want to mention one more time that if you wanted to sign up for an individual 45-minute one-on-one counseling session with Dr. Hanson, you can do that in Bearboard. We have 2 openings left, one at Wednesday at 9:45 and another on Wednesday at 11:15. Or if you are an incoming student or alum, you can chat me directly and I can schedule that appointment for you. I'm going to keep the chat feature going for just about another 2 minutes, and I'm going to stop the recording now.